Alright students, this is your accounting coach ARD, and today we are going to discuss a question of manufacturing accounts. This is a question from past exam papers for the year 2013 and it is variant 21. The name of the owner in this question is Paul Lee. Let me read the question for you first. The following balances were extracted from the books of Paul Lee, a manufacturer, on 31st May 2013. Now, if you are watching this video, I'll suggest that first you may go through my earlier video, and the earlier video contains all the concepts and formats for this topic. And if you have already done this, now you can watch this video so that you may understand how this question needs to be attempted in the CAIE exams. Previously, this question used to come for 40 marks, but now, as you may be aware, the syllabus has been changed and there are slight changes in the exam format, and the change is that the 40 marks question has been removed from the new curriculum of O-level CIE, and the syllabus code has also been changed from 7110 to 7707. So let's move forward. It is a list of balances that is given. Firstly, we have capital. The capital is always opening capital. Closing capital is never given in the examination. It always needs to be calculated through statement of financial position. Then we have drawings. Then we have factory machinery at cost, means we have bought the machinery for 210,000. Then we have equipment, office equipment, it is also on cost. Then we have provision for depreciation. Provision for depreciation, as you may be aware, is also known as accumulated depreciation, means this is the total depreciation till date of the assets, such as factory machinery is being depreciated for 75,600. Then we have office equipment depreciation, that is 21,600 till date. Then we have inventory as it is written 1st June. The year ends for Paul Lee at 31st May 2013. If the year is ending at 31st May 2013, year will be starting at 1st June 2012, that is previous year. Though these three types of inventories, these are all opening inventories because it is written 1st June. And if you may see the additional information right away, additional information is given for 31st May, that is closing. The inventory that is given in the list of balances is opening inventory because it is mentioned 1st June, and the inventory that is given in notes, that is additional information, it is always the closing inventory. And there is another hint, first is for opening and 31st is for closing, and there is another hint that 2012 is opening inventory and 2013 is closing inventory. Now I have given you three hints so as to identify that which inventory is opening and which one is closing. Firstly, the inventory that comes in the list is opening, inventory is coming, that is in additional information is closing. First date is opening and 31st is closing. 2012 is opening and 2013 is closing inventory. You may not see the month, otherwise you will be confused. And then what we have purchase of raw material. Okay, there are three types of inventory, as we earlier discussed in the concepts lecture, that in manufacturing account there are three types of inventory. First of all, we have raw material. Raw material, that goods is in the raw material form. For example, if we are constructing a house, the cement, the bricks, and the nails and the electric equipment and all these things, wiring, these are all in the glass, wood, these are raw material form. Then we have work in progress. Work in progress is incomplete goods. Either they are completed at 10% or either they are being completed till 90%, but if these goods are still in process, these are known as work in progress. As you may see, you are going in some road, traveling at some point, and you may see there is a signboard written that sorry for convenience, that work in progress, means the road or the underpass is being constructed and the construction has not yet been completed. This is known as incomplete goods. And then we have finished goods that are completed goods and that are ready for sale. Then we have purchases of raw material, that we have bought new material for our factory. Then we have revenue is sales. Then we have transport cost. Now what does this transport cost comprise of? We need to see the additional information for this transport cost. As you may see in the note 2, it is written transport costs are allocated 65% to raw material and 35% to delivery of finished goods. This means out of this transport cost, 65% of the transport cost belongs to raw material purchase. This is known as carriage inwards. Carriage inward means when we were buying raw material from a supplier, we used our transport to transfer these goods from the supplier's factory or supplier's maybe warehouse to our factory. This is known as carriage inwards, and it will be charged to manufacturing account, which will be making later. And then the 35% remaining of the transport cost, that what we will do, we will multiply 29,400 times 35%. So we will be multiplying 29,400 to 35%, and this 35% is carriage outward. This is delivery cost of finished goods. So delivery cost will be charged as an expenses when we will be making income statement later. Then we have wages and salary. We will be discussing wages and salary in detail in near future. Then we have rent and rates. We need to see that how much of the rents belong to factory. Let's discuss these. Note 4. In note 4, it is written rent and rate are apportioned 80% to factory and 20% to office. What do you mean by apportion? Apportion means we need to divide them. So we will be splitting this rent and rate. 80% rent belongs to factory and 20% belongs to office. The factory portion will be charged to manufacturing account, and the office portion will be charged to income statement. Similarly, there are some other expenses. Selling and admin. Selling and admin totally belongs to office or income statement. Then we have light and heat. Again, there needs to be some detail of light and heat as to how much light and heat belongs to factory and how much belong to office. Now it is written as 70% a portion to factory and 30% to office. Again, the factory portion of light and heat will be charged to manufacturing accounts, and the 30% remaining will be charged to income statement. These were in arrears. Arrears means owing or accrued. If we say arrears or outstanding or accrued or due or unpaid, this all means the same thing. Arrears means we have used light and heat worth 860, but they have not yet been paid, so these will be added in while making income statement or manufacturing account, because end of the year accrued is always added, and this will be charged as a liability, current liability in statement of financial position. Then we have bad debts, also known as irrecoverable debts. Bad debt is always an expense and it is charged to income statement. Loan interest, we'll be discussing this later. Trade payables, also known as creditors previously. Trade receivables, also known as debtors previously. Then we have a bank balance. Bank balance is credit, means this is bank overdraft. If it is written as credit balance, this is a bank overdraft. This is a short-term liability which will be shown as current liability. Then we have a 6% bank loan, means we have to pay interest of 50,000 times 6%. 50,000 multiplied by 6%, that is 3,000 interest need to be charged to income statement. Then we have some other adjustments, and finally there is a requirement. It is a 40-mark full-length question. First we need to prepare the manufacturing account, which is worth 15 marks in the CAIE exams. Then we need to make an income statement, previously known as trading and profit and loss account, but the new name is income statement. Then we have a statement of financial position, which was previously known as balance sheet, which is of 12 marks. This total makes a 40 marks full length question. Now let's start solving this question. Students, what do you need to do? You need to print this question from either the past paper examination website, CAIE website, or you may also download this file from the video description link. In the YouTube video description link, you may find a link that contains a PDF file that contains all the questions that are available on my YouTube channel. So firstly, before moving forward, you must have the question in front of you so that you can see from where I am getting all the information. So We need to make a manufacturing account. For the A part, we'll be writing manufacturing account for the year ended. We'll be putting the heading, and the year ends at 31st May. For manufacturing account, we always use two columns. So in the manufacturing account, what does a manufacturing account mean? Manufacturing account means if we are producing goods in a factory, we need to calculate how much does it cost us to produce these goods in the factory. There are three components in cost, as we discussed previously in the lecture video. Firstly, we have direct materials. There are three direct costs here. One is direct material, another one is direct labor, and the third direct cost is direct expense. We'll be writing firstly direct material. If you are not aware of the format of this manufacturing account, you may first refer to my lecture which is related to the concepts. Firstly, we have opening inventory. There's the format of this. Firstly, I'm making the format and then I'll be embedding the values. Firstly, that is opening inventory. Then we have purchase. Again, opening inventory is for raw material. Purchases is again for raw material. Then we'll deducting return outward, also known as purchase return. Then we have carriage inwards. If we are buying goods and we are paying transport costs, this increases our overall cost of material. Therefore, we are adding carriage inward, that belongs to raw material. Then we have closing inventory. We are deducting the closing inventory because these goods have not yet been sold and they have not been used. Raw material has not yet been used, and we'll be using this raw material in future periods, next year. So therefore, we are deducting here right now, and in the next year we'll be adding it as an opening inventory. Then after adding and subtracting these items, we have cost of raw material consumed. Cost of raw material means in the factory, in this period, the goods that we have produced, this is the cost of raw material that is used in producing those finished goods. Then after raw material, we have direct labor. Direct labor is also known as factory wages, or there are three words for factory. One is factory, one is production, and one is manufacturing. If I say manufacturing wages or factory wages or production wages, this all means the same thing. Direct labor is the labor directly involved in making a product, such as factory labor, production, cutting, painting, assembly department labor. Thirdly, we have direct expenses. Direct expenses, either the question will state the word direct expense, or either the question will use the word royalty. What does the word royalty mean? I've already discussed in the concepts lecture. Royalty means if we are producing some goods and the goods are not our proprietary material, means the formula for producing these goods or the brand name belongs to some other individual or company, so we will be paying them the royalty for this. So this is known as royalty. And royalty, after royalty, let's move forward. If we'll add all these costs, all the direct costs is known as prime cost. Sum of all direct costs is known as prime cost. Direct raw material consumed, and then direct labor, and then direct expense. All direct costs comprise of prime cost. Then after prime cost, we have still touched the direct cost. We have not yet discussed any indirect cost. Then we adding indirect cost, which is known as production overheads. I've already discussed production or factory or manufacturing overheads mean the same thing. Overhead means all the indirect cost, whether it is indirect material, indirect labor, or indirect expense. All the indirect costs are known as factory overhead. And lastly, what we need to do, we need to make an adjustment for work in progress. Work in progress, we already discussed, these are incomplete goods. We'll be adding opening work in progress and we'll be subtracting closing work in progress. Then in the end, we'll be getting production or manufacturing cost, or also known as cost of goods manufactured. Means in the factory in this period, the goods that we have produced cost us this much amount. So this is manufacturing cost or production cost. Now let's put in the values. If you can see the question, if you can open the question with you. And first of all, we have opening inventory at 1st June, which is written in the list. That is raw material inventory, that is 33,000. It is already mentioned. Then we have purchase of raw material, which is 133,687. I am getting all these values from the question. Then we have return outward. In this question, I don't think there is something as return outward or purchase return, because I have already made the format. I'll be putting a dash in front of that, hyphen in front of that, and if you are making concept on the go, if you are making the format on the go, so we need not write this line, we'll need to delete this line, return outward. Then we have carriage inwards. The carriage in this question is mentioned as transport cost, as we have discussed earlier, and in the note, that is note 2, you can read the question again. In note 2, it is mentioning that 65% of the transport cost relate to raw material. So what we need to do, we need to multiply the transport cost total with 65%, and we will be getting carriage inwards cost. Means 65% of the times our transport is used for bringing in raw material to the business. Then we have closing inventory, which is mentioned in note 1. Closing inventory will be deducting this. After adding all these three and deducting the closing inventory, will be getting cost of raw material consumed. That means in the factory, the goods that we have produced has the total raw material content of 147797. Then we have direct labor of factory wages. In this question, there is something very difficult adjustment for direct labor, and in the trial balance or in the list of balances, I may say, there is an item known as wages and salary. So wages and salary is given 140,600, and how will we know how much of the wages belong to factory and how much belongs to admin, and which is direct and indirect? For this, I need to discuss note number 3. You may read the note number 3. In note number 3, it is given wages and salary include 56,000 for production manager's salary. First of all, I'll be writing the total amount of wages and salary, and this is the rough working I need to do in the exam. The total amount of wages and salary that we have paid is 140,600, and out of this 140,600, there is production manager's salary, and we need to deduct production manager's salary first. Then we'll be getting the remaining balance. And in note 3, it is mentioned the remaining balance is split 40% to direct labor. Now we need to split this 84,600 into three different items. One is 40%, which is direct labor, and the 35% is indirect labor, and the remaining 25% is office salary. Now if we add all these percentages, we'll be getting 100%. 45 plus 35, 40 plus 35, that is 75 plus 25, 100%. Now what we need to do, first of all, we need the direct labor. So we'll be multiplying 84,600 into 40%, we'll be getting a direct labor. What does direct labor mean? Direct labor means the labor which is directly involved in making the products, or the labor that we can trace, or we can identify directly the labor, that how much time is taken by labor to manufacture or assemble one unit. If the labor is taking 10 minutes to make a unit, this is known as direct labor. So all the labor that is working directly in the factory to produce an item is known as direct labor. Then we have direct expense or royalty. If we can see in this question, there is nothing known as direct expense or royalty. If the question states general expense, we will always assume it is an indirect expense. If it is a direct expense, the examiner will clearly say that it is a direct expense or it is a royalty. No third name is used for direct expense or royalty. There are only two names: direct expense or direct factory expense, or royalty. If we add up all the direct costs, we'll be getting prime cost. Now after prime cost, we'll be getting some other things, that is production overhead. Production overhead or indirect costs, these are the costs that are used in the factory but do not directly relate to the factory. These are indirect costs. These are the costs that cannot be directly traced. First of all, we have depreciation. Depreciation, as you may be aware, is charge on non-current asset. So in this question, there are two non-current assets. One is factory machinery and another one is office equipment. Factory machinery, the name is obvious, it is used in factory, and office equipment will be used in office. If an asset is used in office, its depreciation will not be charged here, it will be charged in income statement. But if a non-current asset is being used in the factory, its depreciation will also become the part of manufacturing account. So if you can see the notes, In note 8 it is mentioned clearly that factory machinery is depreciated at 20% reducing balance method. Now what is the cost for factory machinery? If we see the list of balances, factory machinery cost is given 210,000, and the provision for depreciation heading you can see factory machinery provision is 75,600. Mean we have bought it for 210,000 and 75,600 value has been reduced till date. So if we deduct 210 minus 75,600, the amount that we'll be getting will be net book value of factory machinery, and we'll be multiplying 20% to this. We'll be getting depreciation for factory machinery. Because it was a reducing balance question, so therefore I'll be deducting provision for depreciation first. If the question states that it is the straight line policy such as it is given for office equipment, so what we'll be doing will be multiplying 210,000 multiplied by 20% directly, then we need not deduct this 75,600. okay, this is for straight line, and we will be deducting this for reducing balance. Then we have wages and salary. As you may be aware, we have already discussed the adjustment for wages and salary. Now there are two items relating to factory. One is production manager. Obviously the production manager works for production department, so this is indirect cost. And then there is one more indirect cost, that is 35%, maybe for supervisors or factory cleaners or maintenance personnel, or maybe stores manager. These are all indirect labor. So these are two labors. One is production manager's salary. We can write all together, we can add both of them, or we can also show them both of them separately. And the last, the office labor 21150, office related wages and salaries will be charged to income statement. Okay, in factory only direct or indirect factory costs will be charged, but office income office expenses will be charged to income statement. Then we have something more, that is rent and rate. So how can we know the rent and rate is used in factory? It is mentioned in note 4 that 80% of the rent relate to the factory. So what we need to do, will be multiplying total rent cost with 80%. This will give us the share of factory. Then we have one more thing which is known as indirect factory expense. It is already given in the question, indirect factory expense. Then we have heat and light. This is a kind of difficult question which I have selected for you. There are so many adjustments in this question. If you can see the note number 5. In note 5 it is mentioned that light and heat are a portion mean divided to factory and office in the ratio of 70 and 30 respectively, and light and heat are also in areas. So what we need to do, first of all will be adding the areas, that is accrued. 23140 is mentioned in the list, and then we'll be adding accrued or areas, that is 860. So the total expense for light and heat becomes this amount, and we'll be multiplying 70% to this, because 70% of this relate to factory and 30% relate to the office. All of the office admin or selling marketing stuff will go to income statement. Now I'm adding all these indirect costs. So this is a total for indirect cost. Now this was the total for direct expense 181,637, and 170,113 is the total for indirect. So we'll be adding direct and indirect. The sum of direct or indirect is known as 351570. So there is no name for this, but we need to calculate this because sometimes the examiner gives 1 mark for this no name figure. Then lastly we'll be adjusting work in progress. Opening work in progress adjustment is already given in this list of 1st June. Opening work in progress is 36,000, and closing work in progress is given in note 1, that is 42,600. So if we can deduct opening from closing from opening, you may see that the closing work in progress is greater than opening. If we deduct both of them, the amount that we'll be getting is a negative amount. If the amount is the final adjustment is negative, we'll be deducting this adjustment from this sum of all direct and indirect costs. And if the opening work in progress was greater than closing, the amount that we'll be getting is a positive item, and we'll be adjusting this positive item. This netting of this item is necessary because sometimes examiner give 1 mark for this netting off. So what the students the students write all these both of these two items, opening and closing, and do not show this net figure. The net figure contains 1 mark in the exam. And finally, we will be getting the production cost or manufacturing cost. So production or manufacturing cost is basically the total cost, that the total amount that it cost us in our factory to make these goods, not to sell these goods, just to make these goods for resale. After manufacturing account, this is a marking scheme, that the marks that have been allocated by the CAIE examiner to each item. Then we have income statement. Income statement, as you may be aware, you may have studied the income statement for sole trader previously. So there are slight changes in the income statement for a manufacturer or sole trader. First of all, this is sales or return inward. This is the same and doesn't make any difference whether it's manufacturing account or it is sole trader account. Sales, then we deduct cost of sales. Cost of sale means the goods that we have sold in our outlet cost us this much amount. So for cost of sale, again we need opening and closing inventory, but now this opening and closing inventory relates to finished goods, not to for the raw material or work in progress. Opening inventory is for finished goods. We do not need to write this FG in the exam. This is just for illustration purpose. Then we have production or manufacturing cost. We'll be getting this production or manufacturing cost. This will be getting from part A. We have already made manufacturing account for this question, and we'll be getting the final answer for manufacturing account as production and manufacturing cost. Then we'll be having purchase of finished goods as well. Now what does purchase of finished goods means in this context? Means we have a factory, we are making good for ourselves, and we have an outlet as well, and this income statement is we are making for the outlet. It is not necessary that in our outlet all of the things belong to our own factory. Maybe in our outlet, sales outlet, some of the goods that the customers are demanding, we are arranging for them from some outside suppliers. So therefore we have purchase of finished goods as well. If the question mentions purchase of finished goods, we'll be adding this as well. So this is not given in all the questions, but in some of the questions it is mentioned. Then if there is return outward, that is known as purchase return, will be deducting it. Again, this is for finished goods. Everything is for finished goods. Then if there is some carriage inwards, basically carriage inwards will be belonging to this purchase of finished goods. If we are purchasing this from outsiders, this will be a carriage inward. Then there will be a closing inventory for finished goods. Again, we'll be getting cost of sale. Cost of sale will be written 2 times. First of all as a heading, and the secondly as a final answer. Then if we'll be deducting cost of sale from sales, will be getting a figure of gross profit. Gross profit, as you may be aware, this is not the final profit. There are 2 adjustments need to be made. One is other income. Other income contains anything that is received or receivable, rent receive or receivable, commission receive or discount receive, or maybe decrease in provision for doubtful debt, or if there is a gain on disposal. So any income other than selling of goods will be coming in other income. Then instead of expenses, we'll be writing non-manufacturing costs. Again, the format is given in the conceptual video lecture. Then the non-manufacturing overhead instead of expenses. In non-manufacturing overhead, we'll be mentioning any cost other than factory, that is selling, marketing, advertising, admin, office or loan interest and bad debt. These are all non-manufacturing. So in the question, if we may read the question again, revenue is given instead of sales. So revenue and sales mean the same thing. The revenue is mentioned. Then we have opening inventory. Opening inventory is mentioned in the list. That is opening inventory of finished goods. Manufacturing cost, we have already calculated this manufacturing cost previously. You may see this manufacturing account comes from the manufacturing account, that is part A. So we'll be writing this manufacturing cost. Then we don't have purchase of finished goods. This is mentioned in very few questions. If it is mentioned there, we'll be adding up purchase of finished goods as well. Then the return outward or carriage inward is not there. Closing inventory is mentioned in note 1 for finished goods. We'll be deducting this because these goods have not yet been sold. These will be selling this in future periods. Then we'll be adding both of these and we'll be deducting this. We'll be getting the figure for cost of sales. Then revenue minus cost of sales figure will give us gross profit. So this is not the final profit. There are two adjustments. One is other income. There is no such thing as other income in this question, such as rent received or commission received or discount received or decrease in provision. The provision is being increased in this question. Now all of the expenses that are not belonging to factory will be coming in income statement. Firstly, we have depreciation. As you may be aware, there are two types of asset. One is factory machinery and one is office equipment. Factory machinery depreciation, we have already charged it to manufacturing account, and the office equipment depreciation will be charging to this. If we may see the note number 8 mentions the depreciation rate for the office equipment, that is 12% on cost. So if we may see the office equipment cost, the cost of office equipment is given in 60,000 in the question, and will be multiplying 12% to this. Because it was a straight line method, will be multiplying directly, and if the question said office equipment is also charged on reducing balance, what we'll be doing will be deducting provision for depreciation first, that is 60,000 minus 21,600, then multiply by 12%. Then we have carriage outward. As you may be aware, in this question, transport cost was 29,400, and in the notes we have already discussed that 35% of transport costs relate to delivery of finished goods. So we'll be multiplying 35% to this in order to get the carriage outward or delivery cost figure. Wages and salary, we have already discussed this previously. See, out of 84,600, 25% of this belong to office. So the office wages and salary 21150 will be charging this to income statement, the office part or admin part. So office wages and salary is 21150. Then again rent and rate adjustment is in note 4. So 20% of the rent and rate belong to office. So we'll be multiplying 20% to the total amount. We'll be getting 5600. Then we have light and heat. Again, light and heat adjustment is in note 4. Again, in note 4 you can see 30% of light and heat is consumed in office, and there is also one thing, that is arrears. What you need to remember, first of all, you need to add arrears or accrued, or if there is a prepaid, we need to deduct this first, and then we'll be multiplying by 70 or 30%. Because if we multiply 23140 into 30% first, then we need to adjust 860 also multiply by 30%. So this is somehow time consuming. So I suggest, first of all, in any adjustment, if there is an accrued or prepaid at end of the year, accrued will need to be added and prepaid at the end of the year will need to be subtracted. Then we'll be multiplying 30% or 70%, whatever it is mentioned. Then it is a selling and admin cost. If you may see in note 6, selling and admin has been prepaid. So the prepaid amount will be deducting from total amount. Why will we need to deduct this? Because this prepaid item belongs to the next year, not in this year. Bad debt or irrecoverable debt, also known as irrecoverable debt, it always charged in income statement, whether the bad debt was already written off or bad debt is need to be written off. It is always charged to income statement. Then we have increase in provision for doubtful debt. In note 7, it is mentioned that provision for doubtful debt needs to be created at 4%. Needs to be created. Created means we are creating provision for the first time, and the provision is not mentioned previously in the question. So if the provision is being created for the first time, you may be aware this is always an expense. So you may see the trade receivable figure mentioned in the list, that is 34,400. Bad debt need not be deducted from this because bad debt is mentioned in the list. If the bad debt is mentioned in the list, means the bad debt entry has already been made. If the bad debt entry has already been made, this means bad debt has already been deducted from trade receivables. The entry is bad debt account debit and trade receivables account credit. If the bad debt has been debited, so trade receivables must always be credited. So already had been credited. So we need to multiply 4% in order to create a provision for doubtful debt. So the doubtful debt is created. This is an expense for the business. If the doubtful debt is decreased, so we'll be writing it in other income. Then we have loan interest. As you may see in the question, the total amount of loan that we have taken is 50,000, and we'll be multiplying 6% to this. That amount 50,000 times 6%. This means total amount is 3,000. So total amount is 3,000, but out of this 3,000, something that is mentioned in the question as loan interest paid. You may see the question in the list after bad debt. It is mentioned loan interest paid. So out of this 3,000 loan interest, 2,000 had already been been paid, so that 1000 loan interest is accrued. So the total amount of loan interest that we need to pay this year is 3000, and we have already paid 2000. This means 1000 is accrued. So 1000 will be need to adding up this here. And when why I have this added, I have added this amount, we need to show this 1000 accrued. So the total amount will be charged as 3000, and this 1000 will also need to be mentioned in statement of financial position under current liability. Now I am adding all of these non-manufacturing overhead which belongs to office, admin or selling or marketing. Then we'll be deducting expenses non-manufacturing overhead from gross profit figure in order to get the final profit figure for the outlet, that is profit for the year. Dear students, lastly we need to make a statement of financial position, also known as balance sheet, for this question. So as you may be aware, the statement of financial position is being made in a 3-column format. The CAIE examiner prefers the 3-column format, so therefore we'll be making in 3 columns. We'll be writing the name of the owner, then statement of financial position, and then we'll be using the word as at 31st May. So statement of financial position is based on accounting equation, which is assets is equal to capital plus liability. First of all, we'll be writing assets. So after asset, we'll be mentioning non-current assets will first. So in 3 columns, in first column, we'll be giving the heading for cost, then accumulated depreciation, then thirdly net book value. So there are 2 types of assets. Statement of financial position is a combined one for factory and office. It will including both types of assets. Either they are being used in factory or either they are used in office or admin department. Then we have 2 types of assets in this. One is factory machinery. As you maybe see the third item in the question, factory machinery cost is mentioned 210,000. Then previously we have provision for depreciation, that is 75,600. So the question already states the provision for depreciation for previous years for 75,600. Now what we'll be doing, we'll be adding this year depreciation in this. So in current year, that is 2013, we have charged depreciation of 26,880, and previously the depreciation that is mentioned in the question 75,600. We'll be adding up both of these figures in order to get the total accumulated depreciation till date. 75,600 plus 26,880 becomes 102,480. So we have bought this machinery for 210,000, and out of this 102,480 value has been depreciated till date, and if we're deducting these 2 figures, we'll be getting the amount of net book value. Net book value is the value that remain in the books at this date. Then we have office equipment. Will be doing the similar process with this. Office equipment has already cost us 60,000, and in the question you may see that office equipment provision for depreciation, also known as accumulated depreciation, is 21,600 previously. Then in income statement we have charged depreciation for 7,200. So we'll be adding 21,600 with 7,200 in order to get the total depreciation, that is 28800. So out of this 60,000 will be deducting 28,200 total depreciation in order to get the final figure for 31,200. We'll be adding these 2 figures for net book value in order to get the total figure. Now the cost and accumulated depreciation, the role of them has ended, and we need the net book value, that is final figure. Then we have current assets after non-current asset. In current asset, we'll be writing inventory first, and inventory will be closing inventory because the balance sheet we will be making at year end. So there are 3 types of inventory in this manufacturing scenario. One is raw material, one is work in progress, one is finished goods. We'll be mentioning all of these 3 separately. So if you are already aware of the format for statement of financial position for a sole trader, there is some slight difference in this manufacturing account income statement, and the slight difference is that there are 3 types of inventory here, but in the sole trader question there is only one inventory, that is finished goods. So closing inventory is mentioned in note 1. We'll be writing in first column so as to add all these, and the total comes in second column. Then after inventory there comes trade receivables. The trade receivables is mentioned in the question 34,400. Bad debt has already been deducted, so therefore I am not deducting bad debt again. So how come we are aware that bad debt already been deducted? See my dear students, if the bad debt is mentioned in the list, of balances. This means the bad debt has already been deducted, means bad debt entry has already been passed, bad debt account debit, and trade receivables account has already been credited. Now after bad debt we will be deducting provision for doubtful debt, and in this question in the note number 7 I guess it is mentioned that 4% provision need to be created, so we'll be applying a 4% to this total amount 34,400 in order to get a provision 1376. So we'll be deducting 1376 from this figure in order to get the net figure for trade receivable. So after trade receivable we'll be getting other receivable figure. Other receivables, in other receivable we'll be getting two items, we'll be mentioning two adjustments. One is accrued income if there is any in the question, and another one which is more common, that is prepaid expense. So in this question prepaid expense is already given in notes, that is note 6. Selling and admin is the prepaid. Then in this question bank balance is not given, instead we have a bank overdraft, so therefore bank overdraft is not being displayed here, it will be mentioned as current liability. So now what I am doing, I am adding up all my current assets in order to get the total for current assets, and now after adding non-current asset and current asset I'll be getting total for assets. So you may be aware of your earlier studies that there is one thing known as accounting equation, which is assets is equal to capital plus liability. So assets is equal to capital plus liability. There are two types of asset as we mentioned earlier. One is non-current asset and one is current assets. One is non-current asset and another one is current assets. Then we have already discussed both of these assets. Then after assets we have capital and liabilities. After assets we'll be writing capital and liabilities. So this is left capital liability. Capital is mentioned the same way as we used to do when making sole trader accounts. First of all we have opening capital, which is already mentioned in the exam list, that is 220,000. Then we have profit for the year. Profit for the year also previously known as net profit, but in the newer term that the examiner is using is profit for the year. Profit for the year we have already calculated this figure from an income statement 18366. This is the profit for the outlet. Then we have drawings. Drawings are already mentioned in the list. We'll be deducting drawing because drawing reduces our capital. So if we add opening capital and profit, then deduct drawing, will be getting the total capital, that is closing capital figure. We need not write the closing capital because it is an understood figure that will be starting with opening capital, will be getting a closing capital figure. Then we have non-current liabilities. So firstly we mentioned non-current asset, then current assets. Therefore, and liabilities also will be showing non-current liability first, then will be showing current liability. So there is a non-current liability in this question, that is a 6% bank loan, and the year also need to be mentioned, that is 2018. So if there is only one loan, mostly there is only one loan in the examination question, we'll be writing in the third column. Or if there are two loans, we will be taking two loans, we'll be writing in second column and then adding up the figure so as to show the total figure for loan. So this 6% in 2018 is a must to write in the exam. If we are not mentioning 6% 2018, we'll be losing 1 mark for this. Then we have current liabilities. Current liability comprised of trade payables, which is already given in the question. Again I am writing these items in the second column so as to add up and take this to third column. Then we have other payables. In other payables we have two items, one that is common, that is accrued expense, and another item that we can write in this is prepaid income. Prepaid income is also a liability. In this question accrued expense is there, that is heat and light in arrears, and then we have loan interest. Loan interest we have already mentioned that we have a loan of 50,000. If we multiply 6% to this, if we apply 6% to this, we'll be getting a total figure for 3,000, and out of this 3,000 loan interest, 2,000 have already been paid, so the 1,000 loan interest is accrued or outstanding. So we'll be showing this adjustment here. Then we have bank overdraft, which is already mentioned in the question. Now if I add up all the current liabilities, this is the figure. Now what we need to do, we need to equate this. Assets should be equal to capital and liabilities. Asset side we have already calculated. Now we'll be adding capital and non-current liability and current liability in order to get the total figure for total capital and liabilities. So I've tried my best to use the formats that are being used by examiner. So I hope you understood this question, and if you didn't, you must rewind this video and watch it once again. So I hope you understood and benefit this with this lecture, and if you did, kindly please subscribe to my channel, and please do mention other students for this lecture. Thank you.